Mahantesh Sabarad as well joins in on the show right now. Mahantesh, hi afternoon. Quite a bit of rebound within the financials, Mahantesh, from the lows. Do you think it's time to profit take in the near term, or would you say that the concerns around NPAs are a little overblown and overplayed?
Good afternoon. Thank you for having me. On the financial space, I think what you would have noticed is when the market started falling, it was underperforming as a sector to the broader market. And some of that underperformance has been caught up in, has been made up, I would say, in this period. And therefore, this current rally that we are seeing in financial stock is merely a catch up to the broader indices, and I can read nothing more into it right now. You asked me about the NPA side. It is indeed a worry that NPAs will continue to haunt the industry. But then the good thing about the NPAs over the period of several years now is that after having reached a peak sometime in FY19, FY20 actually it was coming off thanks to certain reform measures of IBC and so on and so forth. And now in this COVID phase, we have a long rope being given to the financial sector through the liquidity measures announced by RBI and the moratorium measures announced by them, plus the government support that we are seeing. So all in all, what will happen is we'll see that the NPA problem will get deferred into the future, probably the second half of the fiscal year. And therefore, right now, NPA doesn't seem to be the worry for the stocks. The index is just merely catching up the underperformance.
Yeah, absolutely. Kunal, do you sense that along with the market reversal, if at all there is going to be one, banks again would slide? And if so, then is there a trade that you would take on the financials from here?
Aisha, over the last
Kunal, is my voice reaching you?
Yes, Aisha.
Yeah, I just wanted to know what you're feeling about banks. If indeed there is a market reversal that we could see from here, Kunal, is there a near-term trade within banks wherein you think that it's time to profit take?
Well, yes, absolutely. So, I believe that banks and financial services were the late movers. Now, you can attribute that the last 1,000-point rally on the Nifty or 1,200-point rally on the Nifty was purely based on the bank Nifty. But then look at this in the context of what transpired in the last 3 months. So, bank Nifty at one point of time was just about in breaking distance of the previous March lows. So from there we've rallied. Many of the stocks have crossed back or come back very close to their 200 moving averages. Or banking stocks have not shown that substantial sign. So when you see such kind of a reversal, if there is an expectation that the markets could go through a short-term reversal, the late movers in the rallies are the ones which tend to participate on the downside as well whenever the trend reverses. So I think in that regards, there could be a chance that downward drift could happen into many of these names. Now, which stocks and sectors you need to identify in the banking pack to try and look at the shorting opportunities? I would give more weightage to the PSU banking names, more on the short side. So in the last 4-5 days, there have been some good price volume actions, some open interest built up. But again, as I said, out of the banking stocks, PSU banks and particularly those key names on the FNO side were the late movers in the bank Nifty. So if there is any sort of a reversal which you're expecting on the banking name, the PSU banking stocks will be hit the first, and then it will be followed by those mid-cap private sector banks. I think the likes of maybe Bandhan Bank or KTK Bank, Federal Bank, etc., and then trickling it to the large cap private sector banks. So I think if there is a trend in the making, then the trend should actually play out in these 3 steps. As of now, I believe that it's time to profit take bank Nifty in the banking stocks as well as from the Nifty front, because we've closed the gap. There are chances of Nifty going into a consolidation to a downward drift, and when you see such kind of a volatility from an intraday perspective as well, it generally indicates that a trend is about to reverse. It may not happen immediately, maybe take a couple of days more, but I think that could be an opportunity to try and book profits over here.
Mahantesh, what do you think of Telecom? I also ask because the likes of Rakesh Jhunjhunwala very bullish on a Vodafone, for example. The stock's been moving as well, double digits of late. So while we've all been talking about Jio and Bharti and all the major moves happening there, could this one be, the one that really creeps up from behind? Would you look at perhaps Vodafone as a third player with still some chance at surprising in the future?
So the telecom sector has been an outperformer, and you've rightly observed that. But then backing that outperformance for the telecom industry has been a performance that the industry has posted over the several last few quarters. So performance number one, the ARPUs for all the three players, Jio, Airtel, as well as Vodafone, had bottomed out sometime in the December quarter, or even earlier, I would say September quarter, and then the ARPUs have been growing. So that's reason number one why the performance of telecom companies has been better stock-wise. The second reason is that if you look at the quarter-on-quarter growth in AGR from the telecom industry, it's been growing. It was degrowing the last year for several quarters, and now it has started growing quarter-on-quarter. So that's a great performance that has been shaping up for the industry. And plus, we have seen that the industry has attracted investments. We saw the rights issue of Airtel sail through. We have seen the rights issue of, the QIP issue for Airtel sail through, the rights issue of Jio sail through. Vodafone is also talking of certain investments being attracted. So here you have an industry which is attracting fresher investment. It has been doing well in terms of its revenue growth. It's been doing well also in terms of its one of the important metric, which is ARPU. So I wouldn't be surprised if these stocks will continue to do well going forward, given the past underperformance, the past underperformance stack that we have had. And you specifically asked on Vodafone. I don't want to comment particularly on one company, but suffice to say that if and when these companies start attracting more and more investments of the primary kind, which is to bolster their balance sheets, the secondary markets will follow suit.
All right, fair enough. Nikunj, markets this afternoon, some element of consolidation, but overall, of course, as the big bull himself is saying, we're entering new bull market territory.
So, Abha, what you've asked me as to today's price action. Today's price action, if you compare with the handover we got from US markets and the cues we got from Asia, I was hoping for slightly better and more powerful kind of a day, so to speak. Have we entered a new bull market? Well, the price action is telling you that there is a big difference in what currently the economists and analysts are indicating versus what long-term investors are doing. And just not local investors, it is global investors who bought into the lot of HUL or who bought when Kotak Mahindra promoter Uday Kotak decided to bring his holding down in Kotak Mahindra Bank, or when an HDFC Standard Life deal happened. So investors perhaps are ready to take a view that in the medium term the recovery is going to be faster than all of us are anticipating. Analysts and economists are clearly saying that, look, we don't see any real on-ground action and it's difficult to really fathom anything substantial. No company is in a position to give you a guidance. Infosys did not give us guidance. We've not got any guidance from Bajaj Finance. We've not got anything substantial from HUL. We've not got anything meaningful from L&T when numbers came out over the weekend. So we are in a situation where managements are not sharing anything very clearly because the situation is fluid. Analysts who are dependent on numbers cannot really make forecast only on hope and assumptions because they also have to justify the fundamentals and the environment. And then you got investors who are saying, look, there is liquidity, there is no other alternative available, money has to come back to equities, and they're ready to take a risk 2 years or 3 years outside. But that's a dilemma. So individual investors sometimes can take this risk, but fund managers and the portfolio managers who manage public money, they cannot take the risk. That's the difference in what Mr. Jhunjhunwala was trying to indicate versus what the underlying mood point on the market is. Mahantesh, would you agree with me?
Right. I think the liquidity aspect you highlighted is one of the dominant factors that is driving the market up. You've seen the FPI flow was longest in the last few days. And I think in the recent past, we have not seen such large inflows come in through the FPI route. Not only that, the retail investor interest is alarmingly large. When I use the word alarmingly, I'm saying that there are risks in the market, and the risks are because we have a fluid situation that you highlighted, and you very correctly put, not of managements are unwilling to give guidance. So in such circumstances, the alarming flow of liquidity that we see is the only reason that is taking the markets up. When liquidity goes up, the risk level also goes higher, and one should be wary about what's likely to come ahead, because sooner or later fundamentals do catch up liquidity aspect.
What is wrong in liquidity? I mean, somebody is always a buyer, somebody is always a seller. You know, from last 10 years, every time when US markets have gone higher, I've been told that Fed is following a loose interest rate policy. That's the reason why markets are going higher. And this is a story which in a sense was a very popular theory after monetary quantitative easing once started, after TARP money came out, after Fed started after ECB started printing more money. Every time when markets went higher, I was being told it is liquidity which is taking markets higher. But money is money, Mahantesh.
Yeah, you're right. Liquidity is indeed taking the markets higher, but we have also seen that what happens during the taper tantrums. Taper tantrums was a situation not too long ago when a mere expression of interest of pulling out the liquidity led to a huge fall in the market. That was a period when the fundamentals were catching up with the liquidity aspects. So that's reason number one. Reason number two that I want to highlight this time around, which is different, is that in a COVID and post-COVID environment, trade across the globe has collapsed quite substantially. And when trade collapses, the amount of liquidity that flows in and out via the mechanism of trade is becoming very limited. So liquidity in the form of portfolio investments is one part. Liquidity also that gets lost around because of trade and services is not at the same level as we had seen before, and likely not to. It is very likely it will not come back to the earlier levels we have seen pre-COVID levels pretty soon. So in such circumstances, the risks are pretty much elevated. Mind you, when these trade and services liquidity are not happening, there is also pressure on government revenues, right? While we have seen stimulus packages being given, there's also this aspect you have to understand: the government doesn't really have deep pockets. It has deep pockets, but it doesn't really have deep pockets in an environment where its own revenues are under question mark right now. So I think in such circumstances, this is a differentiating aspect of the market. Liquidity is welcome to the markets. I wouldn't say that it's not welcome, but it has its associated risks, which in the current atmosphere seem a little elevated.
Okay, just looking at the market structure, and it's getting a little volatile at the lows. Just a short while back, we were lower by about 25 points, and now seeing that bit of a recovery. So back in the green, 10,170 is where we're currently at. The breadth as well making its fair attempt, but largely running neck to neck as we speak. It's Z, it's PVR, it's Motherson Sumi, it's Interglobe Aviation, and it's Exide, which are the laggards in trade. Mahantesh, how convinced are you about the rally which is playing out in the auto ancillary names, be it the battery makers or pure play ancillaries like a Motherson Sumi, for instance? They've run up pretty hard in the last 1 month, but do you think that this was just a near-term move and it's time to profit take, or do you think one is good to go even in the medium term with these names?
So with the lockdown getting lifted gradually, I think we are going to see a situation where automobile sales will resume its normalcy. So it will be a few months after which we will see normal sales return back to the automobile companies. Partially because they are also low on inventory now. That phenomenon happened because of the transition that we were going through to Euro 6. So when automobile companies start resuming production activities, sales return to normalcy and is likely to return to normalcy in a few months, with a pent-up demand also now showing up, auto ancillaries would naturally start gaining traction in their businesses, naturally start seeing their stock prices move up. So I wouldn't call for any profit taking in the ancillary names right now.
Kunal, you as well have been observing the charts of an Exide, Maharaja Batteries, Motherson Sumi for a while. What is today's pause telling you? Is it time to profit take at least partially?
So yeah, profit take partially. I think many of these stocks, for example, Motherson Sumi, which we were discussing extensively, I think last couple of weeks, had given a target of closer to 104 to 108 kind of a range for the stock, and it's hit those kind of levels today. I think yesterday also, in fact, rather than Friday, the stock had comfortably closed about this 106, 107 mark. So when you see those stocks hitting those resistances time and again, and when there is a mild reversal, I think it's time to take out profits from those stocks. You don't know which of the rallies or which of the corrections actually converts into a trend. So on one side, yes, we are expecting that the markets could go into a bit of a pause, but whether the pause would actually result into a downtrend, I think that only time and many of the other data confirmations could probably indicate. So I think as a prudent strategy, you take out 50% of the profit from the stocks which you've gained at least in the last couple of weeks. Wait for a decent amount of reversal, maybe a 38% reversal or a 50% reversal in the stock prices from their recent trends. And if that happens, then I believe that the risk reward comes back into favor to try and initiate fresh longs.
All right, let's also now get to some more stock perspective. Ajay is tracking the news on Jio with yet another check pouring in. So straight to the math, Ajay, how's it looking now for Jio in terms of that easing debt?
Well, this is the 8th major transactions being announced by Jio platforms in the matter of weeks. During this period of lockdown, they've struck massive deals totaling almost $13 billion. 98,000 crore worth of deals, including the one being announced now, ADIA, Abu Dhabi Investment Authority, putting in over 5,000 crores for picking up about 1.16% stake. This is the 8th such transaction and the second transaction where a sovereign wealth fund. Earlier, it was Mubadala which actually announced picking up stake. But otherwise, so if you look at the pedigree of investors which are coming in, General Atlantic, Silver Lake, all these high quality investors across the world are picking up stake in Jio platforms, so there are two things which are happening. One, of course, is that Reliance Industries is moving swiftly towards its target of wiping the debt off the company's balance sheet, which they had vowed for doing it by March 21, but now it appears it will happen in this calendar itself. The other thing which is happening is that the complexion of company from an oil major conglomerate is completely changing into a technology run company, best in the line with FANG's. Surely the size may be smaller, just about $130 billion worth, versus FANG stocks of $200 billion upwards to $1 trillion. But the complexion of the company is going in that direction because of Jio platforms. So it's becoming a blend of technology, media, telecom, AI, e-commerce, all of that kind of a play, and that is where the big marquee investors are looking at Jio platform in a new light, and that's the value unlocking which is happening as far as these transactions are anything to go by. So another positive news coming in for shareholders of Reliance Industries.
Okay, so that's on Jio. Varun also taking a look at the news on indices, possibly what's driving the stock today, the promoter to buy additional stake from the open market. Varun, just talk us through what we've learned.
There's no better feeling for an investor when the promoter himself is trying to increase stake in the company in which you've invested. And that's what will be happening today with IndusInd Bank shareholders. They'll be cheering the fact that the management has sent a disclosure to the exchange stating intent to hike their stake in the bank. Now, currently, via the two holdcos mentioned, promoter holdcos, that is IndusInd Limited and IndusInd International Holdings, these two will be the vehicles that will be used to purchase further shares directly from the market. The current shareholding stands at 14.68% as far as these two entities are concerned, and this will be upped within the permissible guidelines set by RBI. So that's the only gray area here. We don't know how much stake they'll be looking to buy. They haven't said, okay, we're going to buy 1% or 2%, and we don't even know how much the RBI will allow in excess of what's currently being held. But the fact that they're trying to increase their stake and they have been given permission to pick up a certain amount of shares, the whole street will be keenly looking out for how much the interest really is, how much money the promoters are able to infuse into the bank at a time where fundraise is imminent for all banks. And nonetheless, promoter hiking the stake, always a green flag. So keep an eye out for that counter today.
Okay. Let's understand, Mahantesh, what is in store for a sector which nobody is talking about, and that's PSUs. BL, BHEL, NMDC, Coal India, these stocks have been beaten down to 1/3 or even 1/4 of the intrinsic value they have. These companies will never go bankrupt. There is a Government of India sovereign guarantee. Some of these businesses are so strong that you cannot replicate them. A Coal India mine or an NMDC iron ore mines, or the whole mot around BEL. When will market start saying that enough is enough? There is no point in paying a P multiple of 50, 60, 70 to Britannia, but there is merit in buying perhaps a BHEL at a P multiple of 8 or 9.
You're right when you argue it this way by saying that these government-run companies and you cannot replicate the business models of some of them. But it is also true that some of these business models are not going to survive for too long. Take Coal India. You mentioned Coal India, for example. So Coal India's monopoly is now clearly broken with commercial mining being allowed in coal. Look at BHEL. The entire DNA of the business model of BHEL was supplying heavy equipment for electrical power generation, primarily thermal power generation. You're not going to add any thermal generation capacity pretty soon. We already are running as a country with excessive power generation capacity, and demand, in fact, has actually slipped down. So nobody would like to replicate a BHEL model. Nobody would like to replicate a Coal India model the way you put it. The other aspect for most of the PSU companies is that while the valuations are appearing very cheap, growth is not something which is going to remain sustainable, because for that intrinsic value, the underlying assumption is that growth will be sustainable. Here, most of these PSU companies will have growth which is quite sustainable, and perhaps acknowledging this aspect, what the government is also trying to do is trying to merge a lot of PSU companies together to form one big entity which will have a sustainable growth. We have seen that happen with the case of PSU banks. We have seen that possibly happen with the likes of, let's say, an NBCC to some other companies as well. And we also saw the move where the government went ahead and is trying to consolidate the oil and gas space when it asked ONGC to pick stake in HPCL. So under such circumstances, when the sustainability of the business itself is a little question mark, the valuations obviously get driven down, and therefore I wouldn't say for PSUs enough is enough. I would say that you can have PSUs in your portfolio because they provide you that buffer in the form of dividend yields, they provide the buffer in the form of valuations not dipping further down, and as a portfolio constructor, they become the safer aspect, safer bucket list of your portfolio. So to that extent, yes, PSUs should be held on to, but I wouldn't be overweight on the PSU stocks now.
Okay, that's the word coming in on what's happening within PSU names.